Hello, and welcome to the Me Financial Podcast. I am Michelle Moses, your host. I am a certified financial planner, realtor, and former e-commerce site owner. And today we are going to be talking about lending options for the senior people in our lives, whether it is your parents, your aunts and uncles, or maybe yourself. And today to talk about this, I have Jud Holmes, and he is the owner of Innovate Mortgage, a local Phoenix mortgage brokerage since 2018. He has been a loan originator since 2002 and works with all types of residential buyers, whether it's primary residence, second home, or investment properties, or refinances like what we're kind of going to be talking about today. So welcome.
Absolutely. Thank you for having me. It's great to be here.
Yeah, Jud and I have known each other for a very long time, and we have lots of laughs. And so I thought it would be great to have him on here. He knows so much about mortgages and can just like spit it out like while you're at the bar.
I'm almost always at the bar.
Yeah. Well, you know your stuff backwards and forwards, so I am excited to talk about this. We are going to be talking about a couple options for elderly parents out there, and one is called the Family Opportunity Mortgage, and then the other one that's going to take up more of the bulk of the time is going to be reverse mortgages, because those are a little bit more complicated. So let's start out with the Family Opportunity Mortgage. Now, this one is really new, correct?
Well, actually, it's been around for a while, but there are other types of programs that they can do for the that are similar to the Family Opportunity Mortgage. I've never actually done the Family Opportunity Mortgage because there's been other programs that I've used that were more beneficial in certain circumstances.
Really? So is like the rate more beneficial or something like that?
No, it's the Family Opportunity Mortgage is essentially the children can put a loan in their own name and get primary residence financing, which is going to be a much better rate than a second home or investment property. And they can do that, and they can let their parents move in.
Right.
What I've always done in the past is really just having the kids on as non-occupying co-borrowers, so the parents are still on the loan, still on title, and all we're doing is using the kids' income to help qualify.
Okay.
They essentially do the same thing. The way that I do it with having the parents on the loan as well is it gives them puts it in their credit also,
right,
in addition to the kids that are on the loan. And you can flip that also, and parents can do it for their kids also.
Right.
Yeah.
Okay. And I mean, you could do that. Yeah. I mean, I guess with a young kid starting out, that's how you might do something, right? And it's the same thing with an elderly parent. And so because I get a lot of questions when parents are getting elderly, and it's mostly when they're kind of running out of money, or they're worried about, hey, they might need some long-term care assistance or just help. And what people want to do is they often want to buy their parents' house. And I have to tell you that I think 99.9% of the time I say no, because you can inherit their house and not pay a dime, and you will get it up at this elevated cost basis. So, but if they are co-borrower on the loan, they're all still owners, right? And so they would only get a step up in the cost basis on like 50% or whatever percentage of the house. Or do you have any idea how that works?
I'm not sure how that works, but I think you're correct. Like if the parent passes away and they inherit the house, then obviously you get 100% stepped up cost basis, which is more beneficial than buying it from their parents. So that makes perfect sense. As far as them going on the loan with their parents, I don't know how that would work. I'd seek out a tax attorney.
Yeah, I think that would mess up anyway. So yes, but the Family Opportunity Mortgage would also mess that up. So that, that's kind of off the table with what we're talking about here at the beginning. But just be aware that if you are putting your name on your parents' home, then you are going to you want to talk to a lawyer, because it is going to mess up your cost basis of something that you would inherit.
I would think so, yeah.
Yeah. So anyway, the Family Opportunity Mortgage, or what you're talking about is doing the co-borrowers, is an option for elderly parents. And you would basically just get a better rate than you would, because, when you're buying a second home or investment property, you have a higher rate of interest that you are paying. And these kinds of options will help get that down, and obviously then get the monthly payment down.
That's correct. And also, if you're the kids in this scenario, you can't buy a second home in the same city that you live in. So you're not even allowed to do
Oh,
that.
I didn't know that.
No, because that's...
okay.
Yeah.
So if your parents live in the same house, you'd have to buy it as an investment property.
You'd have to buy it as an investment property, which is going to require a minimum of 20% down. And the rates for second homes and investment properties are pretty close. They used to be a pretty big gap, but second homes are slightly better than investment properties, but they're both considerably higher than primary residence.
Okay.
Yeah.
All right. I didn't even think about that. Yeah. And then with a family opportunity mortgage, you only have to put 3% down.
You can put as little as 3%.
Right. And then you get a better rate too.
Exactly.
And so it'd be the same thing if you were doing the co-borrower thing that you were talking about. You only have to put 3% down on certain houses if they qualify. But
exactly. And
obviously there's always a caveat.
and one of the benefits for doing the co-borrower option is usually if you have children, and let's say that they're 19 years old and they've had a credit card for at least 6 months and they've got a credit score. If you put them on as a primary borrower, even though they don't have income, the parents can be non-occupying co-borrowers, and now you're not only helping buy a house. Let's say you buy a house for them near a college and they live in there for 4 years. You're not only helping them buy a house and a place to live, but it's also going to help them build more credit because now they've got, when they graduate college, they'll have 4 years of good mortgage history on their credit too.
Okay.
So there are other benefits that are not readily seen by being a non-occupying co-borrower.
Right. Okay. Yeah. All right, cool. Okay. So the other one that we're going to talk about is reverse mortgage, and that's going to take up the bulk of our time because I think that these are becoming more popular because we all have lots of home equity. And what's happening is that the returns of cash, I wouldn't say short-term cash, but a lot of like stock market returns and things are becoming anemic or have been. And people are wanting to tap into the equity that they have in their house. I've been getting more and more calls about reverse mortgages, so I thought it'd be a good topic to have. I don't even know where to start. I think people know them, and then they say, okay, I know to stay away from them because this is the way that they picture it as you're signing your house away over to the lender, and you are basically never going to make a payment, and no matter what, then the lender is going to get your house. And that just is not the case anymore.
Never was the case.
It never was.
Yeah,
okay.
No, that's just it's just gotten bad PR over the
okay.
years. No,
all right.
There has been more regulation in recent years, so that the people that are getting the reverse mortgages are required to understand it better. They actually have to go through a counseling phase during the process with somebody that is not recommended by me. It has to be an objective sort of third party that goes through the counseling with them so that they understand everything.
Okay.
And so once people understand the pros and cons, then they make the decision on whether it's the right thing for them.
Okay.
Yeah. And it's not, and it for the most part, there's a lot of people that it's totally need based. Like if they have if you have somebody that has a $700 per month mortgage payment right now, and they're on a fixed income of like $1,400 a month, they don't have a whole lot of money left over at the end of the month.
Right.
And if you do a reverse mortgage, you first of all get rid of that $700 mortgage payment, and also you can have them getting monthly cash flow every month from the reverse mortgage. So you might get rid of the $700 payment and $400 coming in. So now you've just given them essentially an extra $1,100 per month of money to spend.
Yeah, and you're allowing them to live in their house.
Yeah.
They're still owning it. They're still on the title. You still have the option to never get rid of that house if you want, correct? And you're freeing up some cash flow. And that's when I've seen it too, is when cash flow is tight for seniors and they are worried about, they need money to put on a new air conditioner, and some of that stuff just starts to add up. So let's start at the beginning, whereas age is a big factor in reverse mortgages, correct?
Yes. First of all, you can't even get one unless you're at least 62 years old.
Okay.
So that's the starting point for a reverse mortgage. So you have to be sort of retirement age, or getting close to retiring. You have to be over 62 to be able to even qualify for a reverse mortgage.
And are they better if your house is paid off or not paid off, or have you seen it? I mean, they're just better if you have more equity, essentially.
The more equity you have, the better. Yes.
Okay.
Yeah.
Right. Because it's just more to tap into, because you're basically the reverse mortgage is refinancing whatever you have and paying off that loan. And so obviously if you have more equity, then, you're in less loan amount, then you've got more to live on.
That's correct.
Okay.
Like, we were talking about an example earlier. If somebody has a $400,000 property that's free and clear, depending on their age, let's say that they're 70, they can probably get about $160,000 out of that property on a reverse mortgage. If they owe $100,000, then they could probably only get about 60 out of it. Still good, but the more equity you have, the better, obviously.
Right. Okay. And so the way that this works is, so let's continue with the $400,000. Let's pretend that it is paid off.
Okay.
And you, because the loan to value, how much the company is going to give you depends on how old you are, and that because of the loan to value. So the younger they are, the less the loan to value, correct?
That's correct.
Okay.
And a good rule of thumb is take their age and subtract 30 from it, and that's the loan to value. So if you're 70 years old, subtract 30 from that, 40 is the loan to value. So we take 400,000 purchase or value times 40%, $160,000. And that's where I came up with that number.
Okay.
Yeah.
All right.
I'm not a genius. It's just a trick. Yeah.
It's just a trick. And does the loan to value depend on the rates of the market? You know what I mean? So like since rates have gone up recently, so now are the loan to values kind of depleted, and now it would be more like 37% instead of 40% or something like that?
Right now it's around 31%.
Okay.
So you take, you take about the borrower's age minus 31 approximately right now. It used to be 29 because the rates have gone up. And so since rates have gone up, the amount that you can get it out has gone down. Exactly.
Right. Okay.
Yeah. So with elevated rates where they are right now, that 31 is correct as of right now for today's rates.
Right.
When they're lower a few years ago, you probably could have done their age minus 27 or 28.
Okay.
Yeah.
All right. Okay. That makes sense. And so the way that people need to think about this is that, again, you still own the house, you're still on the title, but the money that you are taking out or your payment. So let's pretend they don't even take any money out. So I have this example where they don't even need the cash really. And, but they just want to not have a payment. So essentially what happens is that you refinance into the reverse mortgage and, you pay closing costs, correct? And those can be are usually like 17. I mean, I guess it depends on the size of the loan, right?
Yeah. It's based on a percentage of the loan. So on a $160,000 loan, there's going to be $3,200 that just gets added to the loan right away. And then there's $6,000 origination fees, and then there's appraisal fees. So it is fairly expensive as far as closing costs. So you need to make sure that you're going to be in the house for a long time to make sure you're going to get some benefit out of it.
Right. You don't want to do this and then move 3 years later because you would have paid all these fees to people to do the loan is the way I think about it anyway. And because you're buying a product. And so if you're only there for 3 years, it's not really worth it.
I think most people, if you probably want to have at least a 5-year time horizon before you even consider it.
Okay. Yeah. All right. Yeah. So if you have elderly parents and you're not sure if they're going to be moving into a home or something like that, this might not be an option or if there's stairs and you're like, yeah, no, they're not going to be staying here, then this is not worth the fees that you would be paying.
That's correct. Yeah,
okay.
That's the first conversation I have with people. I want to make sure that they're even a good candidate for it, because if they're going to be there for only a couple of years, then we're done with that conversation right off the bat, and then it's time to look at different options.
Different options. Okay. Yeah. Okay. And so then basically what happens is you close on it, and there's a certain rate of just like you would have for your normal mortgage, but that is being added every single month correctly to your balance. So the balance is growing.
That's right.
Okay.
So if you started off with a zero balance, all those closing costs get added in. So let's say you start with a $15,000 balance, something like that. So each month, whatever the interest is that accrues gets tacked on to your mortgage.
Okay.
And so if you start with 15, then it goes up $1,000 a month or whatever like that. It sort of depends on all the different parameters of the interest rates and things like that. But yes, over time, your balance is going up. At the same time, though, there's a line of credit that also increases at roughly the same rate as the accrued interest. And so that line of credit that if you didn't utilize any of it at the closing, that's a growing line of credit that you can use. And so you don't have to take it in terms of monthly payments. You can let that accrue, and if your
take it at one time.
Air conditioning goes out, it's a pool pump or something like that, then you can access that to pay for stuff.
Yeah.
But you don't ever have to pay for it.
Right.
I mean, so you can use that to pay for the repairs, but you don't have to actually write a check out of your checking or savings.
Right. It's just there. So I think that when you do a reverse mortgage, there's kind of like what I'm picturing is like two buckets. You've got one that's the loan that's growing, and then you've got one that's the home equity line of credit that is also growing along with your loan. And so I think people's fears are that the loan would start to grow, right? And then the parent passes away, and then the loan is, so this $400,000 example, let's pretend they used $100,000 of their cash, and now their loan, they lived in it for 20 years, and I don't know, the loan was what, 150, 100 or something?
Yeah, let's go back to the original example. If they started with zero balance, they didn't take any money out at closing, so they just started with $15,000 balance on the mortgage, and that at the end of 3 years, that thing is going to accrue to $50,000. So the house still worth $400,000 plus. The reverse mortgage can be paid off by the kids, and they can continue to own the house.
Right.
So,
is there an instance where you have the reverse mortgage and the parents pass away and there's still a lot of equity? Could they just get a loan? I mean, they would just get a loan, right? And just pay it off and just buy it. Well, I guess not, because they inherit it. How does that work?
Well, if they inherit the house, when the senior passes away, the kids have a couple of different options. They can just sell the house and it'll pay off whatever is on the mortgage at that time, and then they'll just keep the money, or they can pay off the balance to the mortgage. Like if they want to keep the house for sentimental reasons or for investment property reasons, they can keep the house. They just have to pay off the mortgage. Once the senior no longer lives there as a primary resident, the mortgage does have to be paid off. The reverse mortgage does have to be paid off.
Right.
And if, as an example, if somebody's in the house and then they go to like the hospital or some sort of extended care for 5 months and then they come back, well, that's okay. If you're gone for more than 12 months from the house, then that triggers the need to pay off the reverse mortgage. So 12 months is sort of the number of how long somebody has to be out there, or upon death. Obviously.
Okay. Yeah. I mean, I have to ask this. How do they know if they've been out of there for 12 months?
There's regular audits.
Oh, there are? So they drive by, or?
I believe that they just, I don't know how, but I think they actually just call and verify and they check and make sure that people are still living there.
Oh, okay.
Make sure the borrower is still living there.
Right.
Yeah.
Okay. Yeah. All right.
I'm not sure exactly how they do that, but it is done.
Okay. So they're doing audits to make sure so that they're not getting swindled, basically.
Yeah.
Okay.
Exactly. Yeah.
Okay. All right. Well, that's good. And so do you feel like what do you feel like is a special, what are your overall opinions of reverse mortgages? Because it's like, I have, annuities. I have an overall opinion. Do you feel like these are good for certain people? Like, what is the ideal client that you feel like this would be great for?
Well, there's the need-based client, and that's the typical one that people think of, where the person only has a certain limited fixed income that's not going to change.
Right. And so they need to alleviate a little bit of their monthly.
So if they've got $1,200 per month, this is a specific example of somebody I worked with. Their husband passed away, so they lost the
Social
income
Security,
benefit. They lost the income benefit from their husband. And so now they were only receiving $1,200 a month for Social Security, and their mortgage was $700 per month. So she had $500 per month to live on. And that's obviously not enough in today's day and age. And so we got rid of the $500 payment and started bringing in $600. And so now she just has $1,100 more per month to live on, and
plus a home equity line of credit.
Plus the line of credit continues to grow. Yeah.
Okay.
Yeah.
And so then when you take the money on the home equity line of credit, is there a separate interest rate for that they're charging? Does that make sense?
No,
you're just taking it. That's just built into the loan.
Yeah. So if your balance on the mortgage is $50,000 and you need to take $20,000 out, well, now the balance is $70,000.
Okay.
So it just moves from one side to the other.
Okay. Yeah. Oh, all right.
Yeah. So the line of credit.
In my head, I got these two different buckets, but it's more like it just goes to the other side.
Yeah. If you've got 27, if you've got 100,000 available on the line of credit side, and your mortgage balance is 50,000, well, you take 20,000 from the line of credit side and apply it, add it to the mortgage, and then that's 20,000 you basically can spend.
Right.
Yeah.
Okay. And I feel like if you were buying the home and you knew that we were thinking that this was like your last home, I could see people buying with, they've got all of this cash, they're ready to retire, they're going to buy a one level home, patio home or something, that they just do it with a reverse mortgage.
They can do that, or if they want to pay cash and then do a reverse mortgage afterwards, the numbers work out the same.
They do.
So it's up to them how they want to do it.
Okay.
Sometimes sellers would prefer a cash buyer versus somebody that's doing any kind of mortgage.
Right. True.
So in a competitive situation, if you've got enough money to pay cash for the house, then go ahead, and then you can do the reverse mortgage afterwards if you decide that it makes sense.
Right. If you wanted to tap into it basically and get the money. And so do you think it would be better to do a reverse mortgage? Because if they pay cash for it, then they could just go get a home equity line of credit, but those are like 8% right now. I mean,
well, and that, if you wanted to just have access to a line of credit and you have plenty of income, then that's probably a great idea because there's very few fees on a traditional line of credit. So if you just want to get a line of credit after you move into the house, just to have it available, that's great. Just remember that once you use the line of credit, you have to make a monthly payment on it.
Right.
That's called a forward mortgage, meaning you have to pay the monthly payment on that. But if you don't ever want to make a monthly payment, then you can get a reverse mortgage.
Okay.
But yeah, if you just wanted to have it there for a rainy day and you've got plenty of income, you should not do a reverse mortgage.
Right.
Because the fees don't make sense.
Yeah. This is a reverse mortgage. You want to stay in your house and you just really want to eliminate a monthly payment.
Exactly.
Correct. Yeah. Okay. And I think that's the way that we can really simplify this is doing that.
And that's the traditional one we think of, is the people that have needs based for it. But there are some more sophisticated investors, because when you receive money from a reverse mortgage, it is not income.
Right.
You're borrowing it.
Right.
And so if you want to delay taking Social Security because your benefit's going to go up in 5 years, you could use a reverse mortgage to delay taking your Social Security because your Social Security is going to go up, or if your pension is going to go up.
Right.
So if you want to use it to sort of delay taking some other asset or delay selling other financial assets because you're going to have long-term capital gains or something like that.
Yeah.
There are other, like,
that's a great idea.
Yeah, there's other, more sophisticated versions of this. It's just the one that most people think of as somebody that's heavily in need.
Yeah.
But the financial planners of the world are not starting. I think a lot of people have been doing it for a while. They understand that there are maybe some situations where even somebody that's very well-to-do might do a reverse mortgage just because it would prevent them from having to sell some other assets.
Exactly. Yeah. And that's where I have heard it too, is that they just want to do it. And so are the fees in a reverse mortgage, are they exponentially bigger than a regular mortgage, or are they all about the same?
No, they're quite a bit higher.
They are? Yeah. Like a lot higher?
Yeah, because it's going to be 2% of the loan amount gets tacked onto the mortgage right up front. And then also there's like $6,000
insurance
origination fee. Mortgage insurance, it gets added on also because it is an FHA product in most cases. There are some jumbo products which are a little bit different, but we're kind of sticking with the FHA version of it right now.
Right.
Yeah, so there are fairly high closing costs. So that's why you want
to have it for a long time and just know that this is kind of your retirement plan and you're going to be in here. And then your kids do have the option to buy the house. It's not like, and I think that was the biggest surprise when I was revisiting this, because I think when you start out in your career, you kind of learn about things and then you're like, no. And so now I've been revisiting this over the last year or so. And I was surprised that the title stayed in. I just thought that once you had a reverse mortgage, the bank owned it at the end, kind of no matter what. So
it's still in your name.
Yeah. So it's still in your name. You still have full control. You could still actually get one at 62. And then if you decide to move at 80 somewhere else, you could just sell your house and then take whatever was left. Right.
Absolutely. And there are rare instances, because like in 2008, when a lot of house values went down a lot, people that had reverse mortgages had a line of credit available on a house that was underwater. And I heard an example of somebody that took like their line of credit of $300,000, paid cash for a house, and then tossed the keys to the bank and said, "Here's my house with a reverse mortgage that's now $600,000 underwater. See you later." Right. And so that's a rare circumstance.
It is,
worked out great for them.
Right. It worked out good for them, and that because what you're doing basically with a reverse mortgage is you are assigning the risk over to the bank.
Right.
Right.
Yeah.
Versus us taking regular mortgages, they are taking the risk, but they're getting the interest for it. And
they're getting paid plenty of interest on
the first couple of years.
Well, but they do. The longer that somebody's in a reverse mortgage, probably the better, because you're accruing that line of credit for a long time. And you could end up like that situation in 2008 where the person actually had a higher line of credit than was even available on the house, based on current values, because that line of credit goes up even if the value of the house doesn't go up.
Oh, really?
Yeah.
Okay. I think that's a good planning.
It goes up as it's a formula. It goes up at basically the same rate as the
loan. Okay.
Yeah.
All right. No matter what. It's not like, because in 2008 and 9, they were taking away our home equity lines of credit because the houses weren't.
Yes, but they can't take away a reverse mortgage.
Right. Okay. Yeah. All right. I think that's a wonderful little planning thing right there.
So if you think that the housing market's going to crash,
then go get yourself a reverse mortgage today, everybody.
Yeah. Well, you obviously need to check all the other boxes.
Yes, I know.
But yes, if that's the cherry on top, then yeah.
Right. Okay. Well, do you feel like we're missing anything? I feel like we've kind of given like a brief overview of options for seniors and for the reverse mortgages.
Well, I think we've covered everything. When I meet, because I understand that kids don't want their parents to be A, taken advantage of, or B, a lot of them are looking at that house as a future asset of theirs. And so whenever I do a reverse mortgage consultation, the first one I do, I talk to the senior and make sure that it could be a potentially good idea for them. And then the next meeting is the senior
to the kids
and the kids in person to make sure everybody understands it, because I don't ever want somebody to think that this is not the right plan. And so when you explain all of it the right way, they're like, oh, that's kind of expensive, but they do understand the upsides of it. And so it's important to get the whole family involved as early as possible if you're going to do it, I think.
Yeah.
Because you don't want to have to re-explain everything.
Exactly. Yeah. Well, and I feel like once parents get older, there's a trustworthy relationship with the kids and, all of that. And the kids know what the succession plan is. It really becomes like one big pool of money. And so you kind of are all managing your money together. Yeah. So it's in my experience, that's kind of what happens. So,
absolutely. And I'm going to leave these guides here with you. So if anybody has specific questions, you can refer back to it, or of course you can send them my way and I'd be happy to answer their questions as well. So. Yeah. And Jud's information will be in the show notes. We'll be linking to his website with his phone number and everything like that. If you were wanting to get in contact with him, and let us know if you have any questions or anything. You feel like we covered everything? I think we've covered enough. Okay. We don't have time to cover everything. Yeah, we don't need to get into the... Yeah. Or is there something else you want to say? No, not off the top of my head. Okay. I think we've gotten through the basics that, understanding it can be beneficial in certain situations. And I think knowing when it's not beneficial is just as important. Like I said, if you're not going to be in very long, then that's not the thing to do. It's not going to benefit you. Then you shouldn't be involved in that. Yeah, I mean, because like any financial product, when you're buying a product, you're paying a person and you're going to pay some fees, and so you need to make sure. I mean, like you're buying life insurance, annuities, a reverse mortgage. Just make sure you're going to have it for a while so that the fees are worth it. Exactly. Yeah. Yep. I think we're good. Okay. All right. Well, thank you everybody for listening, and be sure to give us a review, subscribe, and let me know if you have any other questions. We're happy to help. Thank you so much.